Most market corrections arrive with warning signs. A shift in interest rates, weaker economic data, or a gradual change in investor sentiment usually gives people time to adjust. But every so often, the gold market reminds investors that confidence can disappear much faster than it was built. One morning, what looked like an unstoppable rally suddenly became a wave of selling. Headlines called it a healthy correction. Others labeled it the beginning of something much bigger. Billions of dollars changed hands in just a few hours, and investors around the world were forced to ask the same uncomfortable question. Was this simply a temporary setback, or had the entire narrative supporting gold begun to unravel? The answer is far more complicated than a single day's price movement, because what happened wasn't just about gold. It exposed a much larger battle taking place between inflation, central banks, government debt, currencies, and the psychology of investors who suddenly realized that markets rarely move in straight lines. To understand why this moment matters, it helps to remember why gold became so popular in the first place. Gold has always occupied a unique position in the financial system. Unlike a company's stock, it produces no earnings. Unlike government bonds, it pays no interest. Its value comes from something less tangible but incredibly powerful: trust. For thousands of years, societies have viewed gold as a reliable store of wealth when confidence in money, governments, or financial institutions begins to weaken. Every major financial crisis eventually renews that reputation. Whether during periods of high inflation, banking instability, geopolitical conflict, or aggressive money creation by central banks, investors often return to gold because they believe it can preserve purchasing power when other assets become uncertain. That perception became especially important after years of extraordinary monetary policy. Following multiple economic shocks, central banks around the world expanded their balance sheets, governments accumulated record levels of debt, and investors began questioning whether traditional currencies would maintain their long-term value. Inflation accelerated in many economies, forcing policymakers into one of the most aggressive tightening cycles in decades. Higher interest rates were supposed to strengthen currencies and reduce inflationary pressures, but they also created enormous stress across financial markets. Companies faced higher borrowing costs. Governments struggled with rising debt servicing expenses. Banks encountered new risks as the value of older, lower-yielding assets declined. Every adjustment seemed to solve one problem while creating another. During periods like this, gold often becomes more than just another investment. It turns into a financial insurance policy. Institutional investors increase allocations to diversify portfolios. Central banks add bullion to their reserves as a way of reducing dependence on foreign currencies. Individual investors purchase coins and bars because physical ownership offers reassurance that digital financial systems cannot always provide. None of these decisions happen in isolation. They reinforce one another, creating powerful trends that can last much longer than many people expect. But markets are driven by expectations rather than current conditions alone. Once enough investors become convinced that gold will continue rising indefinitely, even positive fundamentals can become vulnerable to disappointment. That is where psychology begins to overpower economics. Every rally attracts new participants who fear missing out. Momentum traders enter because prices are already climbing. Leveraged investors amplify gains by borrowing money to increase exposure. Exchange-traded funds experience inflows as retail investors seek easy access to the market. What begins as a fundamentally supported advance gradually evolves into a crowded trade where almost everyone shares the same expectation. Ironically, that is often when the market becomes most fragile. The reason is surprisingly simple. Prices do not need bad news to decline. They only need expectations that become too optimistic. If investors collectively believe interest rates will fall rapidly, inflation will remain elevated, and economic uncertainty will continue worsening, gold prices may already reflect those assumptions long before they actually occur. Then, even a modest improvement in economic data or a slightly more cautious central bank can force markets to rethink those expectations. The adjustment can be swift because investors are not reacting only to current information. They are recalculating the future they had already priced into the market. This dynamic explains why some of the sharpest declines in gold have occurred during periods when many of the original reasons for owning it still existed. Inflation may remain above target. Government debt may continue rising. Geopolitical tensions may remain unresolved. Yet if investors decide that conditions are becoming slightly less severe than previously feared, the market can experience aggressive selling despite the broader long-term narrative remaining largely intact. Another factor often overlooked is the growing influence of algorithmic trading. Financial markets today operate at extraordinary speed. Sophisticated computer models monitor interest rate expectations, currency movements, bond yields, commodity prices, and economic releases simultaneously. When predefined conditions are met, these systems execute massive orders within fractions of a second. What begins as a relatively small decline can quickly trigger stop-loss orders, margin calls, and automated selling from other trading strategies. Human investors watching their screens may believe panic has suddenly appeared out of nowhere, when in reality, much of the initial movement originated from mathematical models responding exactly as they were programmed to do. The first clue usually appears in a place that many gold investors rarely watch: the bond market. While headlines focus on the daily price of bullion, professional investors often pay closer attention to government debt because it shapes the opportunity cost of holding gold. When bond yields rise, investors can earn a higher return simply by lending money to governments. Gold, by contrast, generates no income. That does not automatically make gold less valuable, but it changes the calculation. Every increase in real yields forces investors to ask whether the safety of gold is worth sacrificing the income available elsewhere. When that question begins spreading through institutional portfolios, even a fundamentally strong gold market can encounter significant resistance. This relationship becomes even more important because financial markets are forward-looking. Bond prices respond not only to current interest rates, but also to expectations about where policy is heading over the next several months or even years. If investors begin believing that inflation is cooling faster than expected, or that central banks may keep interest rates elevated for longer than previously assumed, government yields can move sharply higher before any official policy change occurs. Gold then reacts, not because anything has fundamentally changed overnight, but because expectations about future monetary conditions have shifted. It is often this invisible adjustment, not the headlines, that creates the largest moves. Inflation itself adds another layer of complexity. Many people assume rising inflation automatically guarantees higher gold prices, but history paints a more balanced picture. Gold tends to perform best when inflation remains persistent while policymakers struggle to contain it, or when investors lose confidence that currencies will maintain their purchasing power. However, if inflation begins slowing without causing a severe recession, markets may conclude that central banks have regained control. In that environment, confidence in financial assets can improve, demand for safe haven investments may soften, and capital gradually rotates into areas expected to benefit from stronger economic growth. Gold does not suddenly lose its long-term purpose, but the urgency behind owning it can temporarily fade. This is where investor psychology becomes especially powerful. During long rallies, confidence slowly transforms into certainty. Analysts publish increasingly optimistic forecasts. Financial television discusses ever higher price targets. Social media fills with predictions that the next major breakout is only days away. Retail participation increases because rising prices reinforce the belief that buying now is safer than waiting. But markets have an unusual habit of disappointing the greatest number of participants at the same time. Once expectations become one-sided, even relatively modest news can trigger an outsized reaction because there are simply fewer new buyers left to push prices higher. Professional money managers understand this dynamic well. Their objective is not merely to identify good investments, but to determine whether those investments are already fully valued. A portfolio manager may remain optimistic about gold over the next 5 years, while simultaneously reducing exposure over the next 5 weeks. That distinction is crucial. Institutions constantly separate long-term conviction from short-term positioning. They recognize that strong secular trends rarely unfold in straight lines. Corrections are not necessarily signs that the underlying thesis has failed. They are often periods when excessive optimism is removed from the market before the broader trend resumes. Another reason sudden declines can become surprisingly intense is leverage. Modern financial markets allow investors to control positions much larger than the capital they initially commit. During favorable conditions, leverage magnifies gains and encourages additional participation. But when prices move in the opposite direction, those same positions become vulnerable. Brokers require additional collateral, forcing investors to either deposit more funds or sell assets. If enough participants face margin calls simultaneously, selling accelerates regardless of whether they still believe in the long-term outlook. What appears to be a collapse in confidence may actually be a liquidity event where investors are simply trying to meet financial obligations. Currency markets often amplify these pressures. Gold is generally priced in US dollars, meaning fluctuations in the dollar influence how expensive gold appears to buyers around the world. A stronger dollar can reduce international purchasing power, particularly in countries where local currencies weaken. Conversely, when the dollar loses value, gold often becomes more attractive because it provides an alternative store of wealth against currency depreciation. This interaction explains why experienced investors rarely examine gold in isolation. They monitor exchange rates, sovereign bond markets, inflation expectations, and central bank communication together because each piece contributes to the broader picture. Central banks themselves have become increasingly important participants in the physical gold market. Over recent years, many monetary authorities have expanded their bullion reserves as part of broader diversification strategies. Rather than relying exclusively on foreign currency holdings, some institutions have chosen to increase exposure to tangible reserve assets. These purchases are typically motivated by long-term strategic considerations rather than short-term price fluctuations. Central banks do not usually react to daily volatility the way hedge funds or retail investors do. Their accumulation can therefore provide an underlying source of demand even during periods when speculative investors are reducing exposure. Yet even central bank buying has limitations. Official sector demand can influence long-term supply and demand balances, but it cannot completely eliminate market cycles driven by investor positioning. Financial markets remain highly interconnected. A surge in bond yields, stronger economic data, improving corporate earnings, or renewed appetite for risk assets can temporarily outweigh structural support coming from official institutions. Understanding this distinction helps explain why gold can experience meaningful corrections despite continued long-term interest from sovereign buyers. The supply side also deserves attention because it is often misunderstood. Unlike many industrial commodities, gold production cannot respond rapidly to higher prices. Discovering economically viable deposits takes years of exploration, environmental studies, permitting, financing, and construction. Existing mines naturally become less productive over time as richer ore bodies are depleted. Recycling contributes additional supply, particularly when prices rise and owners decide to sell jewelry or other holdings, but recycled material alone cannot dramatically alter global availability. This relatively slow supply response is one reason gold has historically retained value over extended periods. Nevertheless, slow supply growth does not shield prices from changes in investor demand, which can fluctuate much more rapidly than mine production. Demand itself is remarkably diverse. Jewelry remains a significant source of consumption in many regions, often influenced by cultural traditions and seasonal buying patterns. Technology manufacturers use gold in specialized electronic components because of its excellent conductivity and resistance to corrosion. Investment demand comes through physical bars, coins, exchange-traded products, and institutional portfolios. Each category responds to different economic conditions. A slowdown in consumer spending may reduce jewelry purchases, while financial uncertainty simultaneously increases investment demand. These opposing forces can offset one another, making the overall market more complex than many observers initially assume. Perhaps the most overlooked factor is confidence in the broader financial system. Gold often attracts attention not because investors expect immediate economic collapse, but because they recognize that uncertainty has become unusually difficult to measure. Government debt levels remain historically elevated in many economies. Demographic changes continue placing pressure on public finances. Geopolitical rivalries influence trade, energy markets, and supply chains. Technological transformations are reshaping labor markets and productivity in ways economists are still trying to fully understand. None of these developments guarantees higher gold prices, but together they create an environment where long-term portfolio diversification becomes increasingly valuable. This is why experienced investors often resist making decisions based solely on a single dramatic trading session. Sharp moves attract attention, but they rarely tell the entire story. The more important question is whether the forces that originally supported gold have fundamentally changed, or whether markets are simply adjusting after becoming overly optimistic. The distinction matters because temporary corrections can feel identical to the beginning of major bear markets while they are happening. Only later does the broader context become clear. That uncertainty is exactly where the next chapter of the story begins. Because beneath the volatility, another shift is quietly developing, one involving government debt, fiscal policy, and the future credibility of the global monetary system. If those pressures continue building, the recent shock in gold may ultimately be remembered not as the end of the story, but as the moment investors briefly looked in the wrong direction, just before an even larger financial narrative began to unfold. At the same time, professional investors rarely evaluate gold by itself. They constantly compare it with competing assets. When government bond yields rise significantly, bonds become more attractive because they provide income, while gold does not. If the domestic currency strengthens, international buyers may find gold more expensive, reducing demand. If equity markets recover and investor confidence improves, capital often flows back toward assets perceived to offer greater growth potential. These relationships constantly interact, meaning gold's performance depends not only on its own fundamentals, but also on how every major asset class is evolving simultaneously. Central banks add another layer of complexity. Their policy decisions influence virtually every corner of global finance. A single statement about inflation, employment, or future interest rates can reshape expectations across currencies, bonds, equities, and commodities within minutes. Sometimes policymakers do not even change rates. Simply adjusting the language they use can be enough to alter market psychology. Investors spend enormous resources trying to interpret every word because they understand that expectations about future policy often matter more than current policy itself. Yet perhaps the biggest misconception surrounding gold is that it only responds to fear. History tells a more nuanced story. Gold has experienced powerful advances during periods of economic expansion as well as during recessions. It has risen alongside inflation, but also during times when investors anticipated slower growth and future monetary easing. What matters most is not a single economic indicator, but the balance between inflation expectations, real interest rates, currency confidence, financial stability, and global demand. That balance can shift much faster than many investors realize, which is exactly why sudden moves often appear confusing at first glance. The recent shock, therefore, should not be viewed simply as a disappointing day for gold investors. It may represent something much larger, a moment when multiple forces that had been supporting the market began pulling in different directions at the same time. Whether this becomes a temporary correction or the beginning of a deeper adjustment depends on a series of interconnected developments that extend far beyond the gold market itself. And once those pieces begin falling into place, an even more important question emerges, one that could determine not only where gold goes next, but what it reveals about the future of the global financial system. History has a way of humbling investors who believe they have finally solved the market. Every generation experiences moments when confidence reaches extraordinary levels, only to discover that financial systems are far more complex than any single theory can explain. Gold has repeatedly been at the center of those turning points. Sometimes it has rewarded patience after years of underperformance. At other times, it has disappointed investors who assumed past trends would continue indefinitely. The lesson has never been that gold always rises or always falls. The lesson is that it reflects changing confidence in the global financial system, and confidence itself is constantly evolving. That is why the recent shock deserves to be viewed through a much wider lens. A single correction cannot erase years of structural developments that continue influencing global markets. Governments in many advanced economies still face historically large debt burdens. Financing those obligations becomes increasingly expensive when interest rates remain elevated. At the same time, central banks must balance competing objectives. Keeping rates high for too long can slow economic activity and increase financial stress, while reducing rates too quickly risks reigniting inflation and weakening confidence in their commitment to price stability. There is no simple solution because every policy choice creates new trade-offs. This balancing act affects nearly every major asset class. Equity investors focus on corporate earnings and economic growth. Bond investors monitor inflation and fiscal sustainability. Currency traders evaluate relative interest rates and capital flows. Gold investors watch all of these variables simultaneously because each one influences the metal's role as a store of value. The result is a market where seemingly unrelated events can suddenly become connected. A stronger employment report may influence expectations for interest rates. Those expectations affect bond yields. Bond yields influence the currency. The currency changes international demand for gold. What begins as a labor market surprise eventually reaches the precious metals market through a chain of interconnected reactions. Geopolitics introduces another source of uncertainty that markets struggle to price accurately. Political tensions, trade disputes, sanctions, and regional conflicts rarely follow predictable timelines. Sometimes they intensify rapidly before easing just as quickly. Investors who react emotionally to every headline often find themselves buying after prices have already surged or selling after panic has peaked. Long-term participants generally pay closer attention to whether geopolitical developments permanently alter trade relationships, reserve management, energy markets, or supply chains. Those structural changes matter far more than temporary bursts of volatility because they influence investment decisions that can persist for years. Another important trend is the gradual evolution of the international monetary system. For decades, the US dollar has remained the world's dominant reserve currency, facilitating global trade and financial transactions on an enormous scale. That position provides significant advantages, but it also places tremendous responsibility on policymakers. Around the world, some countries have explored ways to diversify reserve assets, increase local currency trade, or reduce dependence on any single financial system. Gold has naturally become part of that discussion because it carries no issuer risk and is not tied to the fiscal policy of one nation. This does not mean the global monetary order is about to change overnight. Financial systems evolve slowly. But gradual shifts in reserve management can influence long-term demand in ways that are not always visible in day-to-day price movements. Technology is also reshaping how investors participate in gold markets. Access has become easier than at any point in history. Individuals can purchase physical bullion, invest through exchange-traded products, trade futures contracts, or gain indirect exposure through mining companies with only a few clicks. While this accessibility broadens participation, it also accelerates market reactions. Information travels instantly. News reaches millions of investors simultaneously. Automated trading systems process economic releases within milliseconds. Social media amplifies optimism and fear at extraordinary speed. As a result, short-term price swings may appear more dramatic than in previous decades, even when the underlying economic trends are changing only gradually. For long-term investors, this distinction is critical. Volatility often receives far more attention than value. A sharp decline feels significant because it is immediate and visible. Structural forces, by contrast, develop quietly over months or years. Rising debt burdens, demographic changes, shifts in productivity, evolving reserve strategies, and long-term inflation expectations rarely dominate daily headlines, yet they frequently shape the broader investment landscape far more than a single trading session. Understanding that difference allows investors to separate temporary market noise from deeper economic signals. None of this implies that gold is guaranteed to outperform other assets in the years ahead. Financial markets offer no such certainty. Gold faces genuine challenges whenever real interest rates remain elevated, economic growth strengthens, or confidence in financial markets improves. Equities may deliver stronger returns during sustained expansions. Bonds can become increasingly attractive if yields remain high while inflation declines. Diversification exists precisely because no single asset performs best under every set of conditions. The objective is not to predict every short-term move perfectly, but to build resilience against a wide range of possible outcomes. That perspective helps explain why experienced portfolio managers often focus less on dramatic forecasts and more on probabilities. Instead of asking whether gold will definitely surge or definitely collapse, they examine the conditions under which each scenario becomes more likely. They monitor inflation trends, central bank communication, fiscal policy, labor markets, global liquidity, and geopolitical developments together. As new information emerges, probabilities shift. Portfolios are adjusted accordingly. This disciplined process may appear less exciting than bold predictions, but over long periods it has proven far more effective than attempting to anticipate every market headline. For individual investors, perhaps the most valuable lesson from this episode is psychological rather than financial. Markets have an extraordinary ability to provoke emotional decisions. Rising prices create confidence just as risk is increasing. Falling prices create fear just as opportunities may begin emerging. The greatest challenge is rarely obtaining information. Modern investors have access to more data than ever before. The real challenge is interpreting that information without allowing emotion to dominate judgment. Successful investing often depends less on predicting the future perfectly and more on maintaining discipline when uncertainty feels overwhelming. So, what happens next after gold investors wake up to what appears to be a disaster? The honest answer is that no one can know with certainty. The next move will depend on how inflation evolves, whether economic growth accelerates or weakens, how central banks respond, how bond markets price future policy, and how global investors reassess risk. Those forces are still unfolding, and each new development has the potential to reinforce or challenge the market's current expectations. What is clear, however, is that the recent shock should not be viewed in isolation. It is part of a much larger story unfolding across the global economy, a story involving unprecedented debt levels, changing monetary policy, geopolitical uncertainty, technological transformation, and shifting patterns of international capital. Gold sits at the intersection of all these forces, which is why its price often tells a story that extends far beyond the precious metals market itself. In the months ahead, investors will continue watching every inflation report, every central bank meeting, every movement in bond yields, and every sign of stress or resilience within the global economy. Some will conclude that the correction marked the beginning of a prolonged decline. Others will see it as a temporary interruption within a much larger structural trend. Only time will reveal which interpretation proves correct. But one thing is already certain: the events that unsettled gold investors were never just about gold. They were a reminder that today's financial system is more interconnected, more sensitive, and more complex than ever before. And in an environment where expectations can change almost overnight, understanding the forces beneath the headlines may be the most valuable investment of all.